Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh. It's Friday, and the S&P, boom, right to 4,500 as you were expecting.
Yeah, again, the thought obviously was, and we had talked about this, I think, the last 2 weeks, that we were going to see a big drop in the headline CPI, which would lead people to, again, I think, assume that that's going to influence the Fed's decision making in coming months. And I know the Fed is glad to see those numbers, Blake, because they do pay attention to inflation expectations in the University of Michigan and a couple other surveys. And, oil prices, gas prices coming down, the CPI coming down helps keep inflation expectations contained. That's the good part. But the Fed doesn't base policy, on the CPI. It's on the personal consumption expenditures index, which over the last 12 months has gone from 4.7 to 4.6. Now that's going to come down more in coming months. But anyway, the expectation was that we would see the stock market rally, bond yields come down, the dollar would get hit, as we've been talking, gold would get a pop, and everything kind of fell really in place. But I think we're at an interesting juncture, especially in terms of the S&P.
So just we are I think and we're going to talk about it obviously technically here in a minute, but I do want to mention that today's University of Michigan numbers come out. Now I know those surveys are it's not like not a huge sample size. It's like 5,000, I think, right? But consumer sentiment is bonkers bullish.
Rebounding.
Yeah. I mean, it's like way high, and then you got inflation expectations that are still
that rebounded.
Yeah. And so isn't this going to be really tough for the Fed? Because, we have equities, you have the S&P, it's near 78% retracement. Yep. It's almost back at all-time highs. Let's just put it that way. Yep. Most people are not you and I. Most people that, I work at a company, a cement company, a construction company, a tech company, whatever. I just have my money in a 401k, and I'm not going to be one that shifts that money around a whole lot, but I feel a little wealthier right now as a whole. And so
and you feel wealthier too, because you were spending $1.50 more per gallon a year ago for gasoline,
right.
And that helps cash flow for a lot of people, and it makes a difference.
So, dude, I mean, these financial conditions are once again loosening. I mean, isn't this going to make it a little difficult that, the last leg of getting CPI to 2%, isn't this going to be a little tougher for the Fed moving forward?
Yeah. Again, what's going to happen here is over the next 6 months, the CPI is not going down. In fact, it'll probably tick higher in the next 2 months. And then, so the big progress is behind us, really. And a lot of it was energy prices coming down and the reverse base effects. In other words, in the first 6 months of this year, the CPI was subtracting on average 89 basis points from the first 6 months of 2022.
Yeah.
The next 6 months, we're only going to subtract 0.2. So if the CPI comes in at 0.2, which has been like great news the last few months because of the reverse base effects, it's going to flatline. So that's part of the problem, I think, that the Fed has. The other thing, and this feeds into it, Powell has said a number of times, and a few of the other FOMC members have talked about, well, we thought inflation was coming down towards the end of 2021, and then it took off. And they've repeated this as like, okay, we really want to make sure it's headed down. Well, they're not going to feel that confident, if the data starts to tick a little bit higher. Now, again, core measures are going to drop because of the shelter component thing. But with the unemployment rate near 50-year lows, wage growth is still pretty decent. That's the boogeyman right now. Everyone's looking at the CPI. Yeah, is it positive? Of course it is. But the things that the Fed is looking at, will lead them to be really slow moving. So yes, they're going to raise the funds rate at the July meeting. And then I think it comes down to potentially waiting for more data, and so, again, Wall Street has expectations that I think aren't going to get met. And those expectations I think Blake will start to get dialed back. If I'm right, over the next 2 months, we see the CPI tick up. It's going to be like, whoa, maybe the Fed can't ease as quickly as we thought. And that, I think is likely to provide a headwind for the economy.
Well, I'm anxious to get into your charts. And thanks for that explanation. I think, this I was using an analogy earlier this week on one of the trade-off shows that I was on. And I was like, well, this is like I explained I've never run a marathon, but in the military, I've run down on your beaches in San Onofre, down in near Oceanside.
Right. Camp Pendleton.
Well, yeah, in Camp Pendleton, but doing 20-mile runs, I always knew that the first, half, 3/4 of it breeze. It was the last leg of it's always tough, and that's where the Fed's at. The Fed's got that last bit to go. You said the easy part's over. They had a backdrop to bring down inflation, but now it's going to be the tough. This is where the job gets tough, right?
Well, especially again later this year. Again, I really believe that they think that in order to get inflation down and stay down, they need to see more slack develop in the labor market. It's coming slowly, but I keep repeating this. They're looking for the unemployment rate to get up to 4.5% next year. Well, anytime it's gone up by 0.5%, in other words, it gets to 4%, we're likely at the doorstep, if not in a recession. So their base case is, I believe, that we're going to have to probably get awfully close to a recession in order to get the relief we want to see, lasting relief on inflation. And I just think by the end of this year, we're going to see job growth, tick lower. And, it's all coming, Blake. It's just people have been fooled by the extended lag times a lot of these reliable indicators have. And we've talked about this, 19 months for the yield curve. Leading economic indicators, about 10 months. Lending standards going up. Waller gave a speech yesterday, which was kind of interesting because he talked about, well, the 2-year went up so much even before we started to raise rates early last year. And so what he was basically saying is the transmission mechanism on monetary policy is faster than people realize. In other words, it's not 12 to 24 months. I think he's partially right in that, the 2-year went up to 200 basis points and the Fed had just started raising the funds rate. But Treasury yields didn't really didn't go up that much. And as I keep harping, lending standards got ramped up late last year. And there is a built-in lag time there because a small business owner whose loan doesn't come due until September, he's not going to feel the big increase in both rates and the lending standards and whether he'll get the same amount of money. So again, I still believe that we're going to see a market slowdown in the economy in the second half of this year, and things like the student loan stuff, excess savings being run down predominantly are all going to contribute. But it's going to be slow at first, and then the curve is going to pick up. It's kind of like as you get older. I guess you peak at 40. You
Come on,
50,
la
and then
la la
the 60.
la 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 la. Don't want to hear it. I got black balloons last year when I turned 50. Anyway,
all right.
Jim. Hey, let's get in. Let's get into
some stuff here.
All your charts. I want to start off. Well, we're going to start off with your first screenshot, and rightfully so. This is a bit of a victory lap, I see, but I got to tell everybody at home that's listening in to this for maybe the first time. Jim, you've been spot on. I mean, you've been talking. The market's going to continue to grind higher, and you feel that, or have felt that at these levels, it would trap a lot of people getting on the long side because they would believe that everything is good and we're skirting a recession. So tell us about the screenshot and explain where you're at.
Well, thank you for the kind words. I mean, I do think, we provide some decent information every Friday. Hopefully, some both combination of fundamentals analysis and technical. But Tom Lee, who's a thoughtful guy, you never know it, but he's 77 when you look at him.
Wow.
He got a lot of attention.
I would never have known that.
I know. Somebody asked me, how would you think Tom Lee is? Well, maybe 62. And I looked at it, he's 77.
Wow.
anyway, he on CNBC, to his credit, says, "Hey, I think the next 100 points they're up, and so forth." Well, that was Monday. Last Friday, you and I were talking, and I said, "Hey, the CPI, I think and you were nice enough to put 4,500 in my Monday macro tides." I said 45.10 or 45.20. The S&P got to 45.28, I think, this morning. So this is just like, hey, Tom Lee is on CNBC many times every single week. On Twitter, it's like, oh my God, that's got to be one of the greatest calls of all time. The only thing I'll point out is last year, Tom was pretty bullish, even as the market was performing poorly. So, he does good work. I'm not trying to take anything away from him. But I just thought, hey, he wasn't the only guy who was looking for a pop. And, as you said, a small victory lap.
I don't know if Tom Lee there's no way he is in his 70s. No way. No way. I don't believe it. I think he's in his 50s. But anyway, I'm going to go. I'm going to.
You have to look that up.
I'm going to continue on, and I'm sure somebody's going to jump in the comments and straighten us all out. So, hey, the next chart you have here is your July 10th weekly technical review and expectations. Yep. So, how right were you here?
Well, the S&P hit 45.28. The Qs traded, I think, 381.82. The Russell got to 1951. The dollar, I think 99 something. I think it still has the potential to drop a little bit lower. Gold got to 1963, and GDX got to 3240 this morning, and the TLT got to 101.97. So, again, this is the combination of looking at the fundamental news that was coming, and then looking at chart and technical analysis and saying, okay, how might this play out in markets?
Well, Jim, that's fine and dandy, and you've been damn spot on. But what have you
lately?
What have you done for me lately, Jim? I mean, I see, I hear you. I think you're great. No, jokes aside, you've really guided this group well. And for those of you at home, if you've taken advantage of Jim and his analysis in recent days, weeks, months, maybe the last year, make sure you give him a thumbs up and jump in the comments below and tell us how old Tom Lee is. Thank you very much. Let's go into your next chart that you brought up, Jim. And this is CPI expectations, right? Perspective. I'm sorry.
Yeah. Okay. So, we talked the last 2 weeks. Hey, you're taking 132 basis points away from June of last year. And, potentially I was thinking between 2.9 and 3.1, it came in at 3. But the middle part, and hopefully you can read this stuff, is fuel oil down 36%, the gasoline down 26%, nat gas utilities down 15%, used cars down 5%. So my point is the big decline we've seen. Remember, oil was like 125, $30 last June. So we've seen this. So the sectors that have fallen the most are beginning to bounce. And the other point I make, in July, the takeaway effectively is 0. So if the CPI comes in, again, with a good month-over-month reading of 0.2, the CPI is going to go, the headline will go from 3.0 to 3.2. In August, it's only 0.12. So to me, we get the August print in mid-September. The CPI may rebound from 3 to 3.3, maybe as high as 3.5, depending on what energy does in the next 30 to 60 days. The core rate, though, is going to continue to nudge down. You can see over there the takeaway value for July is 0.3, so it may not drop a whole lot. But then you look at September or August and September, it's 0.6. So the core came in at 4.8. I think over the next handful of months, it can drop down to 4.2 or so. So we're going to get this dichotomy, where the headline is bouncing and the core is still coming down. But more people pay attention to the headline and they think it guides monetary policy, and the headline is going to jump a little bit over the next few months.
All right. Well, I think everybody needs to be paying attention to that, especially, like I said, I truly believe this is going to be the more difficult time for the Fed, and they're grappling with it. All right. So the next chart you brought up, Jim, let me just confirm it is energy, and we're going to go into the energy and what it looks like. All right. So crude oil rallied.
So this is, to buttress and follow on the comments I just made regarding, hey, we've seen this gigantic decline in energy prices over the last 12 months.
Yep.
Natural gas prices obliterated. Okay. But oil's gone from 68 to 75. Now, just looking at this chart, I think it's going to 80 to 81, 82-ish. All right. It gets above that 82 level. Next stop will be 87, 86 at least, and so forth. So my point being is, I think we're going to see energy prices based on this chart work their way higher. Well, that's going to bleed through the CPI. Natural gas, 225. It popped to 291. I think might be a little bit below that where it is now. But I think the odds are it's going to take out 291. The next stop is around 340. Well, that'll be up 50% from the low we saw. So the only point I'm making is that people are getting so crazy. Oh, look at the CPI, and how much it's fallen. Guess what, folks? That game is over. The reverse base effects are going to go from being a big tailwind to a headwind, and some of the components that have brought it down the most are going to show some positives. Used car prices, yeah, they're going to continue to come down. A couple other like airline fares down 8%. Is that going to keep happening? Probably not. So anyway, this is, again, I'm trying to look forward a little bit in terms of everybody's celebrating about the CPI. It'll be interesting, Blake. Last October, the S&P bottomed on an ugly CPI report. And it potentially, the bookend, is going to be making a high here on a CPI report that, was easy to foresee. But yet it has garnered a lot of attention and obviously a big response.
That would be a hell of a bookend. Speaking of the bookend, here's the long-term chart of the S&P. So give us your thoughts here.
Okay, so here's the risk.
What have you done for me recently, by the way?
I'm sorry?
What have you done for me recently? Great calls up until now, this very moment.
Yes. Okay, so the S&P dropped from 48.18 to 34.92. That could be wave A. You can see how choppy it is, so that looks like that type of a wave A. The rebound has also been kind of pretty choppy. And the mathematics are the S&P rallied from 34.92 to 41.95. And if you add that to the bottom of what I think is wave B within this bigger B wave at 38.09, it comes up with 45.12. The decline from 48.18 down to 34.92, the 786 retracement is 45.34. The S&P got to 45.28. So this is the risk. Now, this is a chart, but why I think one has to be at least observant of this is we have everybody pretty bullish about the economy. And I think we're entering the window of time where at a minimum, we're going to see things slow down pretty meaningfully. I mean, we're not going to fall out of bed overnight. It's going to be gradual in the third quarter, pick up steam in the fourth quarter. But I think that's the risk, is that people don't think we're going to have a recession. And I think, I'm not sure they're ready even for a significant slowdown, even if we avoided a recession. So that's the risk. What that implies is we're going to get a C wave decline that undercuts the 34.92.
So because the C wave is typically your longest wave in an Elliott wave count, correct?
Absolutely. So, I'm just saying equality gets you down there. You could easily get to under 3,200, which, that happens to be the 618 retracement of the rally from 2020 to January of 2022. So my only point is, if the fundamentals, if we were at a point where I could say, the economy, I think, is going to be okay, might even pick up some steam in the next 6 months. We're at the point where the Fed is going to maybe cut rates. I could realistically think that, hey, 3-4 months from now, they'll be cutting. Then that would, I think, undermine the message of this chart. But the fact is that we can look at the fundamentals, at least, from the perspective that we've been talking about, that, hey, we're going to see a market slowdown in the next 6 months, potentially going into a recession. Well, that adds credibility to this price pattern. And that's why the intersection of fundamental and technical analysis, this is a key example. Now, what has to happen? We need to see 5 waves down at some point in time, ideally on a daily chart.
And here's your short term, right?
Yeah, the short term. So, okay, So the bottom part shows the net advanced decline oscillator that I use to identify overbought, oversold. We're finally back to the overbought level, which implies that, we may hang up here for a little while. I think earnings are going to be on balance okay for most companies. But my expectation is that by the time we get to Labor Day, we're going to, even if I was bullish, I'd be say, hey, you know what? It's time for a pullback toward the breakout level, which is between 4,200 and 4,250. Now, if as this thing unfolds, again, ideally, if we see 5 waves down, that'll start to add some credibility to, okay, this thing is going to have a deeper correction. You start taking out 4,200, which is important. It was important on the way up. Well, if you go back down below it, it's important. So it's all right. We have this framework we're working with, but you need proof, step-by-step proof that it's, starting to line up in that direction. I just think at a minimum, we're going to see a pullback, even if I wanted to be bullish. The chart and the price targets and all that kind of said, okay, it's definitely time to be lightening up here. So that's my take.
All right. Well, Jim, that's your take on the S&P, and it looks like, we might, hey, I'm looking at price action on a Friday. We had some rebalancing today in the NASDAQ.
Mm-hmm.
There's a lot of time left in the day, but it isn't necessarily pretty at the time of us.
Well, look at the advanced decline line. Look at the Russell 2000.
Yeah.
Okay. So those are things that under the surface, to me, are saying, okay, they're adding credibility to, and I did a tweet this morning, kind of buy SH, which is the inverse S&P, because I just think at a minimum, we're going to 4,250 and potentially a heck of a lot lower than that, but one step at a time.
The thing, Jim, is I know this is not my show, this is your show, but in the FX world, we're seeing the Mexican peso starting to show some signs of weakness against like the European currency. We call it the Euro Mex, and
Right.
You're seeing a little bit of these carry trades get a little wobbly up at these levels, and they have been all week, which suggests that the money, it's bigger than all of our markets. It's shifting, and it's, when those little shifts happen, you got
some instability. Would that be an appropriate word?
Yeah, you might get some instability, or just people saying, I'm through capturing the carry trade interest of this market, and it might be time that the tide is changing. But that's kind of been changing all week this week. But you've seen what's happened all week this week, right? So anyway, I'll just leave it at that. The next chart you have is of the dollar. So we hit a new low.
I mean, you and I talked for a number of weeks, like, okay, we're going to get one more bounce. It won't get above 104. It didn't. It got to 103.58, I think. And then we're going to, for wave E, and then we're going to see the dollar plunge to lower lows. And that's kind of what's transpired here. The RSI, you can see, is down to 24. So it's getting kind of oversold. I think price target wise, you could make a case for it getting below 99. But, the greater point is that I think it's oversold enough that one has to start looking for, there's going to be a bounce. Yeah. And the bounce would likely take it up to the 100.50 to the 100.80. That's kind of was support. One would expect that at least to rebound. Bigger picture, what's happening here could be auspicious. In other words, there's the potential. What the dollar is telling us and telegraphing is the low 90s is coming. Yeah.
Hey, look, the BRIC countries are trying to form their own little currency union, so maybe that'll feed into it. But let's shift over to gold. Gold, it's interesting, Jim. Gold has not participated in this dollar sell-off. Usually you have gold and the dollar, going in opposite directions, which they have. But, with the dollar just getting smashed, gold has just not participated. So what are your thoughts here on gold?
Well, the thought was last week was that we were going to see a bounce to 1950 to 1975 for what I think is wave B. And, could it pop a little bit more? Of course, beyond that, the high was 1963. But the more important thing is I think there's going to be another decline coming that takes gold below 1894. And at some point in time over the next month or two, Blake, I think we'll complete this pullback from the wave 5 of 5 high that you see on that. That's wave 1 from the lows. We've been looking for a pullback for wave 2. And I think there's another leg down. And then once that completes, my anticipation and expectation is that gold will be making a wave 2 low prior to making new all-time highs. And as I kind of hinted, and I'm still processing and thinking about the dollar, in that, okay, we're going to get a bounce in the dollar. But if I'm right that potentially this breakdown signifies a drop below 93 coming, I don't know that gold would ignore that.
Yeah.
So I think there's potentially a great trading low that's going to develop over the next 30 to 60 days in gold.
Okay. The last chart you brought is TLT. So let's take a look at the bond market, because the bond market, I mean, we've seen, finally it seems like some value buyers are out there this week, finally. But will this continue?
I'm kind of neutral here just because I can't make up my mind. Okay. On the positive side, you can see that TLT dropped below the low that we saw in late February, 98.88, and it got to 98.85. So it's like, okay, did we complete something here? It's possible. But we broke that trend line. We're getting a bounce. The downward trend line to that blue line, you can see, hey, trend is still down. So I'm kind of like in the show me camp where I need to see more strength to convince me that there's a bottom here. Again, I think the economy is going to slow materially. That should be a big tailwind for TLT. I still think there's a decent shot. 115, 117 is a realistic expectation. But at the same time, if the dollar started to really weaken significantly going into early next year, is that going to be problematic for global demand for treasury bonds? And we know if the economy slows, we're already running a huge deficit. Well, if the economy really slows meaningfully, we're going to see a lot of paper coming. So those are the things I'm like in my head, but I'm just not convinced yet TLT has made the low here.
And what's entirely possible, Jim, is your slowdown materializes as you are expecting. Maybe it even comes a little. Your slowdown materializes as you are expecting. Maybe it even comes a little faster than expected. You have institutions run towards the bond market. Whether it's the 10-year notes or 30-year, whatever it is. People go to lock in some of these higher rates and get that return, and the dollar could still perform well even if the if yields are coming down, because it depends on what reason why bonds are rallying.
Right? You're 100% right. I mean, that connection is not super tight. A couple of things real quick. I think I talked about last week about how revisions in the labor market report start to hint that you're at an inflection. Okay, so we saw the 2 prior months, April, May, they nicked them for 110,000. Yeah. This week we saw the credit card stuff. They were looking for 20 billion increase for the month. It came in at 7 billion. A report this week that consumers are likely to spend 10% less on back to school. That's the first time there will have been a decline since 2014. So again, for someone who's anticipating that we're going to see slowdown in the economy coming, those are the types of little tidbits that start to happen that most people aren't paying any attention to, that start to support that story. So, one week at a time.
1 week at a time, Jim, and that's all we can do. Well, we enjoy having you 1 week at a time. So if you all do at home, make sure you contact Jim and reach out to him at, I'll do it, Jim Welsh Macro at gmail.com. Yeah, that's it.
Yep, you got it.
Reach out.
Your recent report.
Yeah.
And, we don't mention this very often. We should. We probably should do it at the beginning of a thing because. But for viewers of, Trader Summit, these videos, 20% discount on my research.
Yeah, yeah. 20% discount. That's a great discount. Make sure you all take advantage of it. I got the update today from Jim, and I think you all should too. So Jim,
Yeah.
I want to thank you for being with us today, and thank you for being with us every week. We will see you in 1 week's time, and we'll see if
Yeah.
this little pullback materializes.
You got it. Thanks, Blake. Have a wonderful weekend.
Thanks, Jim. You too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.